we're switching a little bit gears from math finance to insurance, and she's going to talk about optimal loss reporting in continuous time with full insurance. Jingyi, the floor is yours.
Okay, thank you for the introduction, Savannah. And hello, everyone. I'm Jingyi, and I'm an assistant professor from York University, and I'm very happy to be here today and to learn from so many great researchers. So here I will be talking about optimal loss reporting in continuous time with full insurance. This is based on a joint work with my colleague Dongchen Li from York, Virginia Young from U of Michigan, and Binzo from University of Connecticut. So usually when we think about the decision-making of policyholders, we usually look at how much coverage they should buy, right? And then based on that response, we can further look at how to design the insurance contract, right? How to set the premium. But another very important decision-making for policyholders is that after they buy the contract, when a loss occurs, how should they report losses? So that's the question we study in this work, and we want to find an optimal loss reporting strategy. Okay, so I'll first start with some background and motivation. So when and how should policyholders report losses? I think for almost every individual policyholder of non-life insurance, this is some question we need to think about, right? For example, if we have automobile insurance, if there is a loss occurred, should we report it or should we hide it? If it's a major loss, then maybe we should just report it to the insurance company and have it covered. But if it's a small one, maybe we will just pay by ourselves, right? So the reason is that if we make a claim and if we stay with the same insurance company, then next year when we renew the contract, it's very likely that the premium is going to increase, right? So this phenomenon is driven by the fact that insurance companies apply experience rating for pricing. So when they determine the premium, they not only look at how much coverage we buy, they also look at the claim history, right? For the same coverage, policyholders with, say, a larger number of claims or a larger size of claim, you really need to pay a higher premium, right? So that's why we want to look at this problem. And then, as expected, this problem of under-reporting insurance losses, where policyholders deliberately hide covered losses from insurers, this is widely documented in empirical studies. And here's some evidence from automobile insurance and from home insurance. Okay. Then how should we model this problem? So first, we need a model to describe the experience rating system. So here we choose the simplest one, the Boners-Miller system. This is widely applied in practice and also for theoretical studies on optimal loss reporting. This is arguably speaking the model that researchers choose. So under such a model, usually the insurance companies, they reward a claim-free policyholder in terms of a discount for future premium. So that's the bonus part. And if they do report a loss, then next year the premium is going to increase. That's the Miller's part. The simplest kind of Boners-Miller system is just a model with two rate classes. So based on the claim history of policyholders, they can be divided into two groups. Say class 1, which represent the low-risk people who pay a cheaper premium Pi 1, and class 2 are those policyholders with high-risk profile who pay premium Pi 2. Of course, we require Pi 2 to be strictly greater than Pi 1, right? Then how does the policyholders transit among these two rate classes? So here I will just illustrate the mechanism in this discrete time setup. Suppose the policyholder is in class 1, okay? Then if in this current period there is no claim, then the policyholder will remain in class 1 and pay Pi 1 in the next period. If the policyholder report a claim, then he will be moved to class 2 and pay this higher premium of Pi 2 for the next period. Okay. Then the fact that Pi 2 is strictly greater than Pi 1 this generates incentives for policyholders to hide losses, right? Because this is the amount of premium they can save by hiding a loss. Then we need a reporting strategy, right, to determine when they should report losses. Here we simply choose the barrier strategy, and there is theoretical and empirical evidence for using a barrier strategy, which just says that, okay, we only report those large losses and we hide those small ones. So in each class, there is this barrier B sub I, where if the loss exceeds this barrier, it will be reported. If the loss is below the barrier, then we will pay it ourselves. Okay, this is the barrier strategy. And then about the optimization criteria, here we choose to maximize the expected utility of the terminal wealth of the policyholder. Although some other researchers, they also minimize the discounted costs, including the premium and those concealed losses. Okay. So this problem of optimal loss reporting received a lot of attention dating back to at least 1950s. So this first paper here, they formulate this problem under a discrete time K-class BMS model. And then in the second work, they extend the model to allow for the strategy to depend on the number of claims reported. Okay, but these two papers, they minimize the expected discounted costs of including the premiums and the retained losses, so which essentially assume that the policyholder is risk neutral. And then, except for this review work and two follow-up papers, this problem hasn't been well studied during the past 3 decades. And for this paper listed here, they look for the optimal barrier strategy and they derive it up to the first order conditions of a system of equations whose solvability is unknown. And then our previous work, in this work, we rigorously solve for the optimal barrier strategy for risk neutral policyholder and risk averse policyholder with full insurance. And then we, in the second work, we consider deductible insurance and consider this loss reporting problem. And we further look at how the choice of underreporting would affect the demand of insurance for policyholders. Okay. So all the papers listed here are in a discrete time setup, and optimal strategy is just a constant in time. And also another issue is that in each period, they only allow for at most one loss. Okay, so here we want to look at the problem in a continuous time setup, which can easily address these two issues. Okay, so consider a representative insured who purchases full insurance. So this full insurance assumption is kind of strong and it's hardly the optimal insurance contract. But in reality, we do have some scenarios which force policyholders to buy full insurance. For example, owners of leased cars are required to buy full insurance by the lenders, right? And in this work, we don't look at, say, how the choice of loss reporting would affect the insurance demand. We fix the contract and then we look for the optimal strategy. And then we use this classical compound boson process to model the risk process of policyholder. This ZIs are the sequence of ID losses. And this process N here is a Poisson process with jump intensity of lambda. Okay. And then still we assume the very simple BMS model with 2 rate classes. And if there is no loss reported, then the policyholder will remain in or switch to class 1 instantaneously. Okay, and if there is a loss, then the insured will move to or stay in class 2 also instantaneously. Okay. Then for this barrier strategy, we consider deterministic time-dependent barrier strategy B of t. So that's the barrier used at time point t. And also you may have noticed that I dropped the class index here because we can show that the optimal barrier strategy are equal in the 2 classes. So I will, for ease of notation, I will just use a single function B of t. And then given such a barrier, then we can use process R to keep track of the rate classes that policyholder is in at time point t. So of course we have two values for R, right? And further we can write down this dynamic for this process R. For example, if at t minus the policyholder is in class 1, then at time point t it will be moved to class 2 if and only if there is a loss and the size of that loss exceeds this barrier, right? So this is a two-state Markov chain. And then with income rate C, we can write down the insured's wealth process. So the insured receives this income rate of C and pays this premium depending on which class he or she is in, okay? And then when a loss occurs, if the size of the loss is less than or equal to the barrier, then that loss will not be reported to the insurance company, right? The insured will pay it by herself. Then the wealth will be reduced by this loss amount of Z. If the loss size exceeds the barrier, it will be reported to the insurance company. Then since this is full insurance, it will be fully covered by the policy. So in that case, the out-of-pocket money will be 0, right? So this is very similar to a two-state Markov chain. The main difference here is that this chain is endogenously given chain because its dynamic depends on the control, the barrier strategy, right? But in classical optimal investment and insurance problem with regime switching model, the Markov chain is really given exogenously. Okay, and also this will have an effect on the operators when we start for the AGB equation. Okay. Then the insurer chooses the barrier strategy to maximize. Here we use exponential utility of the wealth at time point tau, where this tau is a positive random variable with finite deterministic hazard function rho. Okay, so this includes the finite horizon as a special case. And the insured will choose barriers that are, of course, non-negative, variable, and also satisfy this technical condition. Basically, this condition means that under the barrier strategy, the wealth process cannot be too negative, which could result in the objective function equaling negative infinity. So that's something we want to exclude here. And we use B star to denote the optimal barrier strategy, and V is the corresponding objective function or the value function here. And then we will just solve for the optimal strategy and value functions by considering the AGB equation. But before that, I'd like to talk more about the operators here because they're kind of different from the classical ones. So suppose we have a pair of functions, right? This T is a time point, X is the initial wealth level, and I is the index for the rate class. So say, for example, at time point T, the insured is in class 1, okay? Then he or she will pay this premium of pi 1. Then when a loss occurs, there will be two scenarios, right? If the loss is less than the barrier, then that will be hidden from the insured. So the wealth will be reduced by amount of Z, right? And also because there is no loss reported, so the policyholder will remain in class 1. That's the first scenario. And in the second case, if the loss random variable exceeds the barrier, then that will be reported to the insurance company. So because it's full insurance, it's fully covered, so the wealth stays at the level of X. But since there is a loss reported, the insured will be moved to class 2 instantaneously, right? So in the operator, we have two sources of jumps, one coming from this concealed loss, the other coming from changes in the rate class. And the case when the policyholder is in rate class 2 can be analyzed similarly. Okay. Then this is the verification lemma. So if we can find a pair of functions V tilde such that they satisfy this AGB equation system and they satisfy this transversality condition, then V2 that would be the value function, and B star, which obtains the supremum here. That would be the optimal strategy, because that gives us a sufficient condition to find the strategies. Okay, then main results. So first we look at the case, the special case, when we have a constant hazard rate function. So that means the random time tau follows an exponential distribution with mean of 1 over rho, right? So in this case, as expected, we will have a time independent strategy. It's just a constant because tau exponential distribution is memoryless, right? Further, we can obtain this qualitative results. The first says that the optimal barrier decreases with respect to the risk aversion. So here the impact of risk aversion on the barrier is similar to the impact it has on, say, a deductible or on the demand for insurance, because you can actually think of this B star as a kind of a pseudo deductible. In the extreme case, if the policyholder is extremely risk averse, then the barrier is 0, meaning that all the losses will be reported. And if gamma goes to 0, which means the policyholder is risk neutral, then this is the maximum level of the barrier. And actually, we can interpret this part as the expected gain by hiding a loss, because pi 2 minus pi 1, this is the amount of premium they can save, right? Then how long can the policyholder enjoy this premium? It's either up to the occurrence of the next loss or up to the end of the time horizon, whichever comes first, right? Because these two events are independent, so the intensity is the sum of them. 1 over this intensity gives us the expected time to enjoy this amount of saving. So we can think of this as the expected gain by hiding a loss. Okay. With this in mind, it's straightforward to understand the impact of other parameters. For example, if pi 2 increases or if pi 1 decreases, then the amount of premium we can save gets larger, right? And the policyholder will have more incentives to hide loss. So B star decreases in pi 1 and increases in pi 2. And also, if, say, a rho or lambda increases, then the expected time period to enjoy this saving is shorter, so we will have a smaller value of barrier. So this is the special case. If we have a time-varying hazard rate function, then here we will need to truncate the problem, truncate this random horizon at a deterministic positive value of capital T. And in this case, this theorem gives us the optimal barrier strategy. So first, at the terminal time point capital T, the barrier is 0, meaning at the end of the horizon, the policyholder should just report all the losses, because the problem comes to an end. We don't need to worry whether the future premium will increase or not. We won't buy any insurance anymore. But ahead of capital T, we will have a generally time-dependent strategy, where this B star depends on A1 and A2, which is the unique solution of this ODE system. So this is a nonlinear ODE system because B star, which depends on A1 and A2, appears here in the integral. It also appears in the survival function of the loss. Okay, then let's look at some qualitative results. So first, ahead of the terminal time point capital T, B star T is always positive. So that means it's always optimal for us to hide some loss from the insurer. Okay, and then there is an upper bound, finite upper bound for B star, which is given by B sub 0, which is the optimal barrier strategy when rho is 0. And in the constant hazard rate case, we show that the barrier decreases in the hazard rate function, but generally this is no longer true for time varying hazard rate. But here we find a sufficient condition for this to be true. And as a corollary, if rho 2 is greater than rho 1 by a constant, then B1 will be greater than B2. So in this case, we will have decreasing result. And third, this is consistent with before, the optimal barrier strategy increases in pi2. And if we, well, for parameters not shown here, the impact is actually indefinite, as we will see later through some numerical examples. Okay, so that being said, impact of parameters on the value function, these are kind of consistent with intuition. So the value function decreases with increasing hazard rate, simply because we assume that the income rate is greater than the premium rate. So with the higher value of hazard rate function, there is just shorter time to accumulate wealth. Okay. And as I said before, this finite time horizon case is also a special case here, right? So in this case, we can directly solve for the barrier strategy by looking at this ODE without solving for that ODE system. And in this case, we have one additional final result. So in this case, the optimal barrier decreases with respect to time. So because here we don't have any randomness about the time horizon, when we get closer to the terminal time point, we need to worry less about increase of future premium. Okay. Then I will show some numerical results, which simply shows that the impact of other parameters is, is indefinite. For example, generally the barrier may not decrease in time. So here in the lower panel, we plot three hazard rate functions, like triangular hazard rate functions. And in the upper panel, you see that the barrier strategy is no longer monotone in time. And also, the optimal barrier may not be decreasing in rho. So in the right panel here, the blue dashed line, this is the optimal barrier corresponding to a smaller hazard rate function. And the red one is the optimal barrier for a larger hazard rate function. And we have this crossing point here. And also this point is far away from capital T. So this is not due to truncating that problem by a finite time point. Okay. And also generally, the optimal barrier strategy is not necessarily decreasing in gamma, and there's no specific order between them. And also from here, you can see that we can have cross points, right? So those are some numerical results. And so in this work, we just formulate and study the optimal loss reporting problem within a continuous time framework. We solve for the optimal barrier strategy either explicitly or semi-explicitly. Our main message here is that, policyholders, they not only get to decide how much they can buy the coverage, they also have the choice of how to report the losses, right? That is also an important question. And further, actually through some numerical studies, we've seen that with this choice, the insurance company's expected profit is decreased by hiding losses. So further, we can look at, say, how this affect policyholders' demand for insurance, right? How that affect the design of insurance contract. Those are all questions worthy of studying. And in a discrete time setup, because we don't have that quite tractable solutions, but in continuous time with tractable solutions, it's likely more feasible to answer those questions. So that's the end of my talk, and thank you very much for your attention.
Thank you very much, Jingyi. Any questions?